There is a new ETF favorite in town. The QYLD has broken so many hearts. Investors are now rushing into the Simplified Volatility Premium ETF, ticker SVOL. But is that 17% dividend yield too good to be true? So let's look at what's in the SVOL, how it works, and if it's a good investment. Then we're going to compare the Simplified Volatility Fund against the QYLD and all those other high-yield income ETFs to crown a winner. But bear with me here because this has to get technical before it gets easy. The SVOL works on a short-term volatility strategy, selling futures on the VIX Volatility Index. Now, volatility is just how much the market or a stock moves up or down in a given period, a gauge of that stock market craziness. The Volatility Index, or the VIX, is the market's expectation for volatility over the next month, so how crazy investors believe stock prices will be. And while you can't invest directly in the Volatility Index, you can invest indirectly through futures, options, and ETFs, betting whether actual volatility is going to be higher or lower than expected. But here, the SVOL isn't really making a directional bet. It's simply saying that market expectations for volatility are typically higher than actuality. Shorting those expectations, so selling futures contracts against the VIX, is a way to capture that fear premium in the market. And the strategy is backed up by research. Testing VIX futures shorting strategies from 2005 through 2015, rolling that short contract over each month was profitable in 8 of the 11 years, with an average monthly return of 0.7% and a total return of 118% over that period. Next, I'll show you the pros and cons of the fund, but first, I want to personally invite you to get the weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now, the Volatility ETF was only just created in 2021, specifically to meet investors' needs against a low yield environment. At the time, interest rates were at historic lows and there was no alternative to stocks. But with rates on risk-free treasury bills now as high as 5%, I think the SVOL still serves a purpose. I just wonder if they're going to change the website to remove that quote. The dividend yield on stocks in the S&P 500 is just 1.6%, and long-term bonds still yield under 4%, so there still is that need for a low volatility return. The biggest selling point for me, though, is that this is a totally different asset class. That premium from shorting the volatility index is reliable and robust, backed up by research, and the VIX has a historical negative correlation with stocks. So when stocks go up, the VIX tends to go down, and vice versa. The correlation here is a negative 0.84, which is very strong and means using that volatility strategy along with your stock portfolio can be a great way to reduce risk. And looking at that chart of the volatility index, the VIX, we can see it has been elevated since the ETF started trading in 2021. That helps to account for a higher yield, but even if the market volatility were to fall to maybe its longer term average closer to 15, that short VIX strategy would still create a premium and a solid yield for this fund. Now, that said, I do think one of the risks to this fund is that during its lifespan, the volatility has been so consistently high that when it does come down to normal, that current yield on the SVOL might not be sustainable. I would expect volatility to fall over the longer term, and that's going to mean a smaller premium on the strategy. Okay, I know all this talking about how the SVOL works is kind of beside the point. You just want to know, is the Volatility ETF safe for your money? Now, the ETF is down about 12% since inception in 2021, though only about 5% over the last year, and producing positive returns when you add in those dividends. So it hasn't necessarily protected you from all the stock market sell-off, but it has helped smooth out the risk. Now, researching this, one thing does worry me that the fund says it's targeting just 0.25% of that inverse VIX return, so I'm not sure how that covers a 17% annualized dividend. And that research found an average 0.7% monthly return, about an 8.1% annualized return from the strategy, which is actually a lot better than it sounds considering it's a negatively correlated asset and a low volatility strategy. But even at that full return, the strategy wouldn't cover a double-digit yield. Now, the fund has only paid dividends since September 2021, so there's very little data here to judge that safety. The dividend has seen 5 cuts and 5 increases over that period, though. So it's going to pay out that cash flow, but with no promises to the amount. Put all this together, and I would bet that dividend yield does come down. It almost has to from the strategy, but even if it does, it's still going to be a solid double-digit yield, which is still solid cash flow. We're going to compare that Simplified Volatility ETF against the ever-popular QYLD next, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, I've been pretty vocal about the shortcomings on that NASDAQ 100 covered call ETF, the ticker QYLD, in the past. The 12.7% dividend lures investors in before eating their hard-earned money, but there are just some pros to the fund, especially versus the SVOL. That QYLD holds tech growth stocks and equity investment versus the futures bet in the volatility fund. So where the QYLD has more upside potential if those tech stocks do run higher. Now, the ETF jumped 28% plus dividends from the pandemic low to the 2021 peak, a 79% total return. That covered call ETF has also been around since 2013 with a time-tested strategy of selling options against those stocks. And while they have done some back testing of results, the SVOL has only had actual trading history since 2021, and we'll never know how it can actually fall apart in a liquidity squeeze or a sudden market collapse until it's tested. Of course, there are just as many cons to the QYLD, with a persistent history of dividend cuts and just the simple fact that it underperforms an investment in the index itself. Over that same period, from the pandemic low to the 2021 peak, the NASDAQ 100 ETF, the ticker QQQ, produced a 102% total return. And then after that, on the downside, the QYLD hasn't protected investors from any of the risk. The covered call ETF has lost 16% over the last year versus just a 12% loss in the NASDAQ index. For its part, the SVOL has only lost 5.5% over the last year, outperforming both the NASDAQ and the QYLD on top of a higher yield. But now, just because the Volatility ETF beats the QYLD doesn't necessarily mean you should buy it. So is the SVOL a good investment? Again, here, I love that this is an opportunity in a different asset class. There are plenty of stock dividend funds and those covered call ETFs basically all doing the same thing. An investment in one of these is pretty much the same as any of the others, and they're all going to go in the same direction along with the market. Instead, here with this volatility ETF, you have the opportunity to spread your risk out into another asset that shouldn't move one-to-one with stocks and can help you keep that return while minimizing the risk. As for the dividend, I wouldn't plan my bills around it because I doubt that it's going to continue to pay out that 17% yield, but even with a cut, it should produce something like a 10% dividend yield. You might lose a little on the price there, but that overall strategy here on shorting futures is proven and can produce a higher yield. Overall, maybe not as good as it looks at first glance, but the SVOL is a good investment. I'll compare the SVOL against all the popular income ETFs next, but the perfect dividend portfolio is always going to be more than just one stock. Check out the video here for our new series, Building the Perfect Dividend Portfolio. Finding that perfect dividend stock with different strategies for the best portfolio. So more than just the QYLD though, the SVOL holds its own against all the other high-yield income ETFs. The chart here shows the Simplified Volatility ETF in red against the QYLD, the JP Morgan Equity Premium ETF, that JEPI in orange, the Global X S&P Covered Call ETF, the XYLD in yellow, and then the Global X Russell 2000 Covered Call, the RYLD in blue. Now, the JEPI has outperformed all of them with only a 10% loss, while the SVOL is close in second here with a 15% loss. Here's a table to make it all a little clearer, and I've highlighted the current dividend yield, the price return, and the total return for each fund, along with the S&P 500 Index Fund, the SPY. You see here, the Simplified Volatility ETF offers the highest dividend yield by far and has produced the highest total return. I still do like the JP Morgan Income Fund, the JEPI, with its 11.5% yield and 6% total return, but this new SVOL is definitely a contender. But I also want to highlight the volatility in each ETF, so that measure of risk or how much the fund has a tendency to rise or fall in any given year. All 5 funds show less volatility than the overall market, just due to their strategies as covered calls. But one of the reasons I still prefer that JEPI is that lower risk, much lower than even the SVOL or the QYLD, while still producing a higher yield and a total return. Now understand here, the Simplified Volatility Premium ETF shouldn't be confused with 2 Invesco funds, the S&P High Dividend Low Volatility, ticker SPHD, which invests in dividend stocks with low volatility, or the S&P Low Volatility ETF, the SPLV, which is just investing in the 100 S&P stocks with the lowest volatility. Now, both of these funds are investing directly in stocks, but targeting the stocks that jump around less than the overall market, so have lower volatility or risk. You can see how that affects the selection in the portfolio of the SPLV, that low volatility ETF, with most of the funds in utilities, consumer staples, and healthcare. So what you get here is these 2 funds are trying to give you that stock market exposure, but with less risk, fewer big ups and downs than the overall market, while the SVOL is doing something completely different, shorting that market volatility. Get your Bowtie Weekly free with the link below, or click on the video to the right for our new series, Creating the Perfect Dividend Portfolio with different strategies, from high yield to safety, ETFs, and by sector. What's in your perfect dividend portfolio? Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.